substantial amount of people already in the room. I know people are still trickling in, but we'll go ahead and get started. I want to thank you all again for joining us today. We have a webinar lined up for you today discussing closing an independent sponsor-led deal during COVID. So we're looking forward to getting to that discussion. But before we do, of course, I have some housekeeping things to get through. For those of you who don't know who I am, my name is Lena Dobreer. I'm the Director of Operations at Opus Connect. We are a lower, middle, and middle market M&A focused organization. We have different chapters, LA, Chicago, and New York, that primarily consist of members in the fields of private equity, independent sponsors, like I'm sure many of you are today, investment bankers, lenders, etc. We also do deal sourcing events all around the country. Of course, everything is virtual now, but we're in various different markets around the nation. So if you want to learn a little bit more about us and what we do, feel free to reach out to my colleague, Jacob Zephyrin. His contact information is below. He'll be happy to answer any questions that you may have. Moving on, today our panel will take live Q&A. They'll weave it into the discussion as appropriate. So on the bottom of your screen there, you'll see a Q&A bubble. Go ahead and submit your questions in there. Please don't use the chat. The Q&A is where you should submit your questions, and our moderator, Natalie, will go ahead and field those, and we'll try to get to as many as possible. These events, of course, would not be possible without the support of our sponsors, so we definitely want to give each of them a few moments just to introduce themselves. Pacific Mercantile Bank. Rob, are you in here? I don't believe you are, but raise your hand. If someone else is a representative from Pacific Mercantile, please go ahead and write that in the Q&A and I'll navigate back to you, but definitely want to acknowledge them. We'll move on to Focus Search Partners. Steve Finder, I don't believe you're in the room today, but all of you that are participating in Deal Connect will hear from our sponsors a little bit later as well. But definitely want to give them an opportunity and acknowledge them. David Cogan of Sapient Investigations, I see you in here. Go ahead and introduce yourself and your firm.
Good morning, Lena. Hi, David Cogan. Can you hear me?
Yes, perfect.
Oh, great. David Cogan. I'm the managing director of Sapient Investigations. We specialize in executive background checks, and we do most of our work with private equity. We do a lot of, we look at basically the human side of a lot of these deals. We look at executives, joint venture partners, management teams, and look forward to meeting you guys all later today.
Thank you, David. Next we have Shepard Mullen. Is Zach in here? Zach Turk is not in. Again, you guys will hear from them this afternoon, but Shepard Mullen Law Firm in Century City. They have offices all over. Feel free to reach out to Zach if you have any questions. We'll move on to the next sponsor here, which is USI. Josh, are you here? Yes, you are. I see you. Go ahead and introduce yourself and your firm, sir.
Thanks, Lena. Hi, everybody. This is Josh Goldberg with USI. We're the largest privately held insurance brokerage in the world, and actually recently now international. We do a lot of work in all industries. I particularly work in real estate and construction, as well as private equity, and do a lot of manufacturing work and distribution in healthcare. Looking forward to speaking with you later today, and hope you enjoy today. Thank you.
Thank you, Josh. I'm going to go back to Pacific Mercantile. I see Matt Rogers is in here. Matt, why don't you go ahead and introduce yourself and your firm, please?
If you strip out PPP.
If you could speak up just a bit, we're having a little trouble hearing you.
Yep, this is Matt Rogers.
Great.
From Pacific Mercantile Bank.
Thank you. Please introduce yourself and your firm, Matt.
Pacific Mercantile Bank, we are an asset-based lender working with private equity companies. Been in business for 14 years now. We're very active. We're doing loans for private equity companies that are involved in merger and acquisitions.
Hello, this is Rob Parks, and Matt's going to be filling in for me today because I'm working on a deal. So private equity deal as it happens to be. So Matt will be meeting with the various sponsors today, a little bit later on today, and we appreciate everybody's participation.
Great. Thank you, gentlemen. We'll go ahead, and I want to acknowledge CohnReznick last but certainly not least. They are a sponsor of today's event as well, but Natalie is going to be moderating. So we'll wait until we introduce her in the panel before we get that introduction. And before we get to the discussion at hand today, we have a couple poll questions we want to ask you quickly. We encourage your participation as the audience. We'd like to know how you heard about today's event. So you'll see a little dialogue box pop up on your screen. Just go ahead and submit your answers. We'll move through these fairly quickly and then we will begin. Great. We'll give it about another 20 seconds or so. This is helpful for us to know who we should keep on the payroll at Opus Connect. Just kidding. But we appreciate everybody's support. We'll go ahead and share those results very quickly. Thank you, speakers, for sharing. Looks like our work on LinkedIn is working as well. So great there. Second question we have today is, which best describes you? This is good for our panelists to know who they're speaking to today. So are you an independent sponsor, an investment banker, capital provider on the debt or the equity side, service provider or other? We'll give it just a few seconds here, maybe 20 or so. And then we have one more question before we begin. Great, let's share those results. Good, so a lot of independent sponsors, which is good. I'm sure most of you are participating in the meetings this afternoon. 16% investment bankers, capital providers split among debt and equity. Awesome, thank you. And then we added a last minute question just this morning, just to give a quick poll to the audience. Would you feel comfortable closing an add-on acquisition without ever meeting management in person? Go ahead and submit your answers there. It'll help as we move through the discussion today. And then we will begin, I promise. It's interesting, we've been asking a version of this question over the last few webinars, and it's interesting to see people's answers change from the beginning of COVID to now where we are. So thank you for participating. We'll go ahead and share those results. Looks like 49% said yes, 51% said no, almost split down the middle, which is interesting. But without further ado, I would like to introduce today's moderator, Natalie of CohnReznick. Natalie, please take it away.
Good morning, everyone. Thank you, Lena. And my name is Natalie Tronkina, and I'm a partner at the Transaction Advisory Services practice of CohnReznick. We do provide buy and sell side diligence services to private equity as well as strategic buyers and sellers. We also provide post-transaction dispute resolution services. And CohnReznick is one of the top national accounting firms providing audit, tax, and advisory services. We focus on about 24 of industries, including technology, healthcare, cannabis, manufacturing and distribution, consumer products, business services, real estate. And we service businesses ranging anywhere from multi-generational owner-operated companies to publicly traded companies. And as a member of international network called Nexia, we can service clients and provide services in more than 100 countries around the globe. Very good to meet everyone. Looking forward to our discussion today. Brad, I think you're on next.
Oh,
very good to meet
hi.
you.
Good morning, afternoon, I guess, depending where everybody's dialing in from, presumably morning for all. Founder and CEO of Starmount Capital. We're a lower middle market asset manager. We provide debt capital equity capital, and we also have a secondary fund business that has a related primary fund investment activity with it. Just over 40 full-time people and 35 operating partners. Recently closed our 100th private investment. As it pertains to independent sponsors, we back many independent sponsors, and one of the things that they like about us, other than being a highly value-added partner that can open a lot of doors for them, is that we can provide all parts of the capital structure, debt, equity, any blend in between. Thanks.
Good morning, Heather.
Good morning, everyone. Heather Madland with Huron Capital. We're, as many of you know, a Detroit-based lower middle market private equity firm. We're focusing on providing control and non-control equity into companies with at least 4 million of EBITDA. We've been around for over 20 years and just crossed our 200th deal mark during COVID. We'll chat with you a little bit about how what we've been focused on the last few months. But generally, our focus is founder owners and entrepreneurs, and buy and build as well from a growth perspective. Our industry focus is consumer products and services, business services, and specialty industrials. Thanks for having me.
Good morning, Sam.
Morning.
Please introduce yourself.
You bet. So Sam Snyder, partner with Greyrock Capital Group. It's good to see everyone this morning. It's my online panels are a real pleasure. So Greyrock, we're a junior capital focused private equity fund, currently investing out of our 5th fund. We had the fun pleasure of raising money during COVID. We've raised $250 million to date, likely to have a final close in the coming weeks. Independent sponsors form a core focus of ours. We've closed north of 40 deals with independent sponsors over our firm's history. And for those that have been in the market for a long time, we traditionally refer to them as funding deals on a deal-by-deal basis, and now it's evolved into a big industry, which we're happy about. So looking forward to meeting many of you at the speed dating event tonight.
Hi, everybody. I'm Courtney. I'm with the Courtney Group. I started the firm in '95 and got into private equity in '99. We've bought or invested in 22 companies since then. We've closed 3 deals this year, including 2 since COVID.
Thank you so much, everyone. I think we'll just get right into it. The independent sponsor community has grown tremendously over the past 5 or so years, I would say. And as you can see, we have a great panel today to speak about really the sourcing, evaluating, and closing the deals during the pandemic, as well as kind of understanding the roles of independent sponsor in the transaction process, and also supporting the businesses post-transaction. Heather, I want to start with you and ask you this first question. As in-person meetings and live conferences cease to exist, how have you been sourcing your opportunities, and what the impacts of COVID-19 have you been experiencing on the deal flow?
Yeah, sure. I mean, virtual is the word, right? So we stopped travel, call it early March, and have been doing conferences and deal sources and panels and trying to be as productive as possible in a virtual environment. And I guess I have to say, it's about time, guys. Like, our industry, it took us a while to get comfortable with this type of technology. It only took a pandemic for us to do it. And I would say we have been wildly productive from a activity perspective. I would say early in COVID, March, April, May, it was about information sourcing and just talking to as many lenders and advisors as possible to keep our deal teams updated on what was going on in the market. I would say since July, when M&A activity started picking up, certainly much of it is deal related activity. But I would say we have blown through our budget last year and this year in terms of interactions and conversations with people. Virtual environments are just simply more efficient. I will say one thing we are focusing a little bit more on is specialization and doing some work around specific industries that we may want to target in a more focused way. And I think COVID is giving people the opportunity to sort of rethink their investment strategy and do some of this type of exploring. I think even pre-COVID, the environment is so competitive for new deals that, and I think COVID has just put a exclamation mark on this as well, that if you don't have familiarity in an industry or sector, you're starting from a negative place, whereas many private equity firms in any industry, someone's going to be ahead of you in terms of their knowledge of an industry. And so from a private equity buyout perspective, that is definitely something we are circling, and I'm spending some work on individually this year around that topic. From a deal flow perspective, I would say there's been two bright spots, save for March and April, where activity fell to zero. I think everybody will, I guess, agree with me that our pipelines dried up in those months. But since then, two bright spots emerged. One is our flex strategy. That's our non-control minority equity strategy. And during COVID, we expanded that strategy to include smaller control deals as well, down to 4 million in EBITDA. And that activity is up 35% over prior year in terms of deal flow. Whereas our flagship platforms, that's down 40 to 50% year to date. So we're certainly seeing business owners look for alternative ways to raise capital or get liquidity beyond just a sale. And so that's certainly helping us in that regard. The other area that is a bright spot for us are add-ons. And I think people would agree overall that we've closed, let's see what the number is. This updates like every day, but we've closed 13 add-ons year to date. 10 of those were during COVID since April. And I think it's much easier to underwrite an add-on in today's environment because we see how our own companies are performing in this time, and so can translate that into the companies that we're looking to purchase as well. And we have 8 businesses under LOI across 3 different platforms. So just a tremendous amount of add-on activity, and have seen lenders be supportive. I have many, many anecdotes on that if people want to chat further, but certainly lenders have been supportive of us as well in that regard. So that's been great. I just think overall flagship deal, like flagship platform activity is going to be down 60% this year, we think. I mean, we've certainly seen a pickup in the last few weeks, but we think it's going to be down. Independent sponsor deal flow is up over last year, and I think that's a function of the non-control product being up as well, and our smaller deal focus in the flex fund.
Actually, that fits. Thank you, Heather. That fits well in the next question, Brad, I have for you. Are you seeing the increasing number of certain types of the transaction? I think Heather mentioned add-ons. Are there any more carve-outs, distress that you've been seeing? And it would be great if you can share. I know you've been successfully closing some of the transactions even during the pandemic, so perhaps maybe a real story would be great.
Sure. Yeah, we've had an increase in add-on acquisitions. Some of the portfolio companies that we worked with pre-COVID, we tried to encourage them to get a financial partner like ourselves in place in advance of what we assumed was going to be a market downturn. We by no means predicted a pandemic, but our house view at Star Mountain was that a recession was very likely from a number of different black swan risk factors, which unfortunately many of those still exist today for what it's worth. But that had us say, let's get ready for the downturn. And a lot of our portfolio companies said that makes a lot of sense. Let's get geared up, be underwritten so that we're capitalized, we're agile, and actually have an active funnel deal flow. So we financed, I think, about 13 or 14 add-on acquisitions in the past few months. Some of them were acquiring competitors out of bankruptcy at what should be hopefully an extraordinarily attractive return opportunity for the business and for us as a debt and equity player in the deal. Others were more just opportunistic, where the retiring demographic, you get some business owners that say, look, I'd like X for my business, but if I can get 20% less than X, I can still go have a lot of fun with my grandkids and don't have to grind through another recession. So a lot of reasons for people being at least somewhat motivated sellers, in some cases extremely motivated, like the bankruptcy scenario. And if you were able to move quickly and swiftly, there was a lot of opportunity in the pretty brief recession that we had. But the good news or bad news is another one will probably be coming in not too long from now. I don't know if it'll be quarters or years, but a lot of risks still remaining out there. So those are a few examples of acquisition financings in the downturn.
And Tom, I think I just want to quickly ask you, how have you been hunting for good deals and really meeting and vetting the companies in this virtual environment?
Most of the deals that we get are from people that we know, and they'll call or email us, and so that's continued. Interestingly, I keep a file of deals I looked at before that the deal didn't happen, and now some of those, I call it the boneyard. Some of those have come back to life, and a deal we had an LOI on 2 years ago, we're working on that again. So I think a lot of it is working with the people you already have a relationship with.
And I think when driving the transaction from the point of signing the LOI and to closing, really the relationship is critical, right? So I just want to ask Sam, I want to ask you quickly, how have the sponsor fund, PE lender, and sponsor management team relationship have been evolving in the current environment?
Sure, good question, Natalie. I'll just cover a handful of aspects. So I guess the way our firm has experienced it, you kind of have a tactical, this is happening so fast, kind of short-term and measured in days side of it. And then you've got, what's playing out now where we're months in and, there's a long road to hoe ahead. On the former, there, I think if you didn't already have very good transparency, a very good cadence of regular communication, that certainly has to evolve into that, because you're either dealing with, a capital structure issue, liquidity issue, potentially mass layoffs, depending what situation you're in. These are all things that they immediately escalate up to a board level. Most capital providers in this space, even if you're a SBIC with minority equity or someone like us who, generally we're providing most or a large portion of the equity, you're going to be involved at a board level. And if you want to add value, if you want to be a good partner, you have to, on the one hand, be very engaged, and on the other, you have to have information to be able to understand, assimilate, and provide feedback on. So just transparency becomes critical. And it's something we try to solve for with our partners. And it's not always a daily thing, not always a weekly thing, sometimes not even monthly. But in COVID, everything is being pulled into a much more rapid cadence. The other part there is it's kind of an interesting one, but kind of composure. Again, in the tactical, you have a lot of very important meetings, things that they get emotional. You're dealing with a crisis, and so this idea of you're not in this environment where it's just you're showing up, you're going through big things, you're going home. You're dealing with massively important decisions for a lot of these companies, and it's just very important. All sides have to have this focus on keeping it professional. Trying to make rational decisions. And personally, for me, I've been through a number of recessions. I've never seen something before that can just really be such an emotional and important experience that requires quick answers, complex answers, and so it just becomes that much more important. So transparency and composure are things you didn't necessarily solve for a year ago, and now they're things you're focused on. And then on now that we're months in, I think a fun one is hey, we spent all this time and all this money crafting an LLC agreement that's supposed to work for all of us through good times and bad times. And now we're actually having to use some of those provisions that are in there. And things like springing provisions based on performance or liquidity or missed payments. And some of these things exist if there's more capital needed, or there's divergence in the partnership and whether you're seeing things the same way. And if you've worked with groups multiple times, that's never something you have to pull out. And if everybody's working as a team and going the same direction, that's great. And fortunately for us, we've got 10 companies and we're 10 for 10 right now in all those. That's fantastic. But I know for others, if you haven't been through a downturn, you've just entered this business, you're probably going and really testing some of the provisions that are in there, and hopefully it's working out for both parties. And for us, it's I don't know if it's a differentiator, but at least because we've been in this business for a while, we've made a lot of mistakes. which make their way into, you know, a sustainable, time-tested governance document. And anytime you're in situations like we had in a number of our companies where you wake up one day and revenue's zero for an undetermined amount of time, that can create a lot of difficulties that you know, you got to work through. You know, just a handful of things, and those are, you know, you could call them evolutions. You could also call them just bringing to the fore, you know, certain elements of the deal-making business, independent sponsor and capital partner marriages that, you know, weren't necessarily as frequent in a long-run bull market.
Thanks, Sam. And there are a few questions coming in through here, and I think we might be able to answer quite a few with this next question. It would be good to hear from some of our panelists, if possibly all of our panelists. How have you been incorporating the impact of uncertainties into valuations, pricing, and the structuring of recent transactions? And Heather, can we please start with you?
Sure, and everyone's going to hate my answer because it depends. Depends on the deal size, whether it's an add-on or a platform. It depends on the industry. Add-ons, like I said before, seem to be a bit easier right now from just an overall structuring and valuation standpoint, getting comfort with that. You know, I think what's interesting is there's a scarcity factor out there right now, whereas the deals that are coming to market of scale for buyouts seem to be those that were fairly stable or even performed well or above budget during COVID. And those companies are still getting pre-COVID type valuation talk. And, you know, someone asked the question about leverage multiples. You know, March and April, we were all very uncertain about how, you know, that would impact, debt markets would impact buyouts, but this is not 08, 09. Like, we still have lots of liquidity in the debt markets. And, you know, I would say maybe leverage is down a half to a turn. I think it's more like a half to 3/4 of a turn. And so the impact of that isn't as significant as maybe we were thinking it might be earlier in COVID. And so companies that deserve those types of pre-COVID valuations there's talk, they're still getting done at that level of valuation. So I think earnout is also a trend. You know, certainly people are talking about structure. I'll give you one anecdote because I think it's really creative. You know, so many of our add-ons during COVID were for our insurance agency platform called High Street Insurance Partners. And we can chat more about the diligence on that one later. But, you know, one interesting way we addressed the uncertainty, I mean, we saw the business was performing and stable, but we were starting to see maybe a teeny bit of softness in our own business. And so we said, well, you know, we really want to sort of mitigate that risk or figure out how to do it. And so we developed something called a maintenance earnout, which is effectively taking a turn of the purchase price and delaying it for 12 months. And as long as the company maintains its EBITDA, doesn't need to hit something higher, just maintains it, they'll get paid that turn of the earnout. And so I think that is one way folks can get comfortable with some of the uncertainty, particularly with companies that appear to be stable today, but you've asked yourselves the question about what about tomorrow?
Right. I'd add one small point, just, you know, something that forces at least evaluation thought is when a company needs more money. And it's, you know, not going to come from a third-party lender. It has to come from, you know, either the capital partner or the independent sponsor. And in most cases, you know, that's us. That's eyes wide open. We go into deals knowing, you know, we're the backstop. You know, what this situation's resulted in is a lot of follow-on financings. And, you know, our view, and this might not necessarily be Covet-specific, it's just being used a lot now, is we're very sensitive to not diluting the independent sponsor, especially for, you know, an exogenous event that, you know, everyone's dealing with. And if new equity has to go into business and you can't pre-wire it in sub-debt, which is what we try to do sometimes just to avoid dilution, is, you know, right now we're putting in a lot of, you know, PIK-only preferred equity with no ownership to just make sure we're not creating a high watermark problem, and to be a good partner. You know, it also ends up just kind of punting on the valuation issue a bit, because you're not, you know, putting in equity in a down round that, you know, could be really temporary, and again is not really anybody's fault. Yeah.
Thank you, Sam. And I think, Tom, I want to quickly want to ask you, you recently, you closed a couple of transactions since February. Were there any unique, kind of uniqueness about the transaction or the pricing or structuring of those transactions that you can share with us?
I think one thing that was different was it got a lot tougher to get people interested after COVID hit. We closed a deal in February. We had 17 proposals to finance it. We closed the deal in August. We had 5. So you know, there were people interested. I'd call people and say, "Are you looking at new deals?" And they'd say, "Yeah, we're looking. We're just not doing them." So a lot of people were feeling like so much uncertainty. They didn't know how far down was, that there was sort of a period of paralysis for a while. I think maybe we're getting through that now. I see signs of it improving. The last business that I bought was out of a bankruptcy. I own a shoe business called Flow Hose, and we bought a competitor that we'd been talking to on and off for about a year. And it was through an ABC transaction, assignment for the benefit of the creditors, which is a state bankruptcy process as opposed to Chapter 11 or Chapter 7, which is federal bankruptcy. And, you know, the COVID basically killed them eventually. We picked up the inventory and the trademarks, you know, at a very liquidation value.
Interesting. I'd like to move to the process, really conducting the virtual diligence. Heather mentioned diligencing certain aspects of the transaction, really virtually meeting people and negotiating terms. Brett, can you talk of any notable changes, something that you've been seeing really changed in the deal-making process itself?
That's a tough one. I just typed an answer for somebody, which I wasn't 100% clear on the question, because a PE firm usually is providing the equity capital, but I took a best crack at it. The one thing that's happening today is less certainty that people will get to a close, right? Especially with banks, but you know, anybody. There are a lot of moving pieces in the economy, a lot of uncertainty that can derail a deal. And so the one thing that we have found, and we've, I guess, sort of adapted, even though we've always sort of been like this, it's even more so now, that we're willing to provide more parts of the capital structure for deals, and all of them. And we've always generally been open to that, but especially now, because we recognize that the more capital providers at the table, the more investment committees a deal needs to go to, the more reasons that deal cannot get done, get delayed, have challenges, make sellers nervous, especially if you've locked in a really good deal and things are performing well, and you want to get it closed. You want to get, you know, certainty of close and speed of close. And so in markets like this, when there are more variables, people tend to want to have fewer capital partners that they can, to just increase the speed and certainty of close. I'd say that's one thing different from today's environment. It's not really a term, it's just more of a dynamic, more so than a term, I would say.
Certainly. I'll add to that, Natalie. I mean, I think one of the interesting areas within the deal process, so we look to independent sponsors to show us proprietary deal flow, but 2/3 of the platforms we close, you know, they're going to be in some sort of a process with an intermediary. And in those deals, what we're seeing is virtual management meetings much earlier in the process. So submitting an IOI, then doing kind of what used to be called maybe fireside chats, but doing them virtually for like an hour or two after submitting the IOI, and then seeing a refreshed IOI after having that conversation, so that the banker is almost whittling down that in-person, first delaying the in-person component of management meetings as far as possible, given I think people's overall discomfort levels at some level with traveling. And then they're also just, I would say, narrowing it down to a higher quality group of potential buyers and interested buyers, because they've kind of gone through the step of meeting management. And at that point, a lot of people will have just an immediate reaction one way or another about their level of interest in an ongoing interest in a deal. And so in some ways I talk to bankers and, they say that may be something that's here to stay as part of the deal process, and leveraging virtual technology a little bit sooner in the process to make sure that you get that high quality interested group of buyers in person later.
Right, and no, thank you, Heather. This is really good, and I think this is what's making this whole new world much more efficient and interesting to navigate through. And there is a question here that I think we might be, Sam, I'm going to ask you. We might be able to answer. How do you isolate the impacts of COVID during diligence and adjust for COVID-specific items?
Good question. One deal we closed during COVID was a pediatric dental practice deal. It was a financing where, it was in a couple of states that were shut down, revenues declined significantly, company had a cash flow challenge. So, one of the requirements there was the weekly cash flow forecast, which has become this universal thing that like every company does, even if you're not necessarily liquidity constrained, just because everyone's managing, a lot more tightly in this environment. And so you have that as a weekly cadence to kind of measure against that. In a typical deal, if you're not looking at, the ins and outs of cash flow, maybe you'll do that once you acquire it and coming out of the gates to get a feel for it. But now it can be a pre-closing item, especially if the business is enduring a COVID challenge. And then the other, interesting part is you need to use logic in terms of, if something is impacted, and trying to understand, will it be a quick snapback or a long snapback, and that you kind of start there. But then also, it's not one direction, right? There are some businesses where the COVID impact is a positive and not a negative. And that can be in certain consumer food segments, it can be in education. And so you need to look both directions, and then, have analyses that compares that to historical. And then, where there's no secret sauce, you got to run sensitivities and come up with, what you think are the best cases or the best range of cases where the company might revert to as, hopefully the world gets back to normal. It's just you can't have precision with time. But through all that analysis, sometimes that'll result in an add back or a subtraction, and you'll look at kind of EBITDA that way. So that's one way we've done it. I wish that we were through the story and I'd have a lot more conclusions to tell you. We're not a high velocity shop, so that's kind of the best I can do on that one.
No, this is helpful. And getting the expected drop in equity values, Tom, how can sellers be persuaded to part with their assets? Are there any ways to really narrow the gap between the buyers and sellers' expectations?
I don't know that the prices have gone down that much, Natalie. I think they're kind of, people who have a good business are still getting a good price. I think what's happening is there's maybe a little less debt available than before, so people are having to do a greater proportion of equity. And I do agree with some of the other panelists, people are putting in, escrows, seller notes, earnouts, things like that as a way of bridging gaps, saying, okay, I believe you're going to, hit your projections, and if you do, here's what you'll get.
There is a question that's coming up about the PPP loan. We do have a question here on the PPP loan and some other stimulus programs as businesses are obtaining and using them in this crisis. And Heather, this is a question for you. How would you deal with the implications of the PPP and other government loan programs in potential M&A transactions, specifically risk allocation consideration in the context of the transaction? Or the
so I'm not an attorney. I'm not going to be able to give you that perspective. But from a deal perspective, both on the buy side and the sell side too, you know, my advice is, and my advice is address it early. Don't wait until 2 or 3 weeks before close and say, oh crap, the company that I'm buying has a PPP loan. What am I going to do about it? Or on the reverse, if you're selling an asset, oh crap, what am I going to do with my liability? You know, the buyer doesn't want it or whatnot. And there's still a lot of, well, no surprise, nuance and lack of clarity around whether the SBA is requiring a change of control consent. So when I say start early, I mean, if you can apply now for forgiveness and haven't, you should go ahead and do that if your bank is accepting applications well before a change of control happens. Or if you think it's going to happen in the future, do it, particularly if you've used the money already. And then secondly, with the SBA consent, look at your PPP note of either what you're buying or what you're selling and see what it says about change of controls. We are in a situation where, you know, the lender isn't requiring a change of control, but the buyer is saying, well, wait, I mean, won't not getting one from the SBA jeopardize forgiveness, you know, at the time? And so, you know, there's just no clear answer from the SBA on this point, but my advice wholeheartedly is to just start early, look at the facts, and pursue what you need to pursue in order to dot those I's and cross those T's so as not to make that a holdup at close.
Natalie, we had one recently and we just set up an escrow and we said, when it gets forgiven, you'll get that money.
That happens. The problem is if there's no consideration left for that, what do you do? And the SBA is routinely requiring that from the buyer in order to approve change of control consents, even though they haven't issued any procedural guidance on it yet. So you just got to be careful in terms of don't you know, it's just in terms of asking for the consent from the SBA. My other comment around forgiveness is forgiveness and eligibility are two very separate things. Forgiveness is a mathematical exercise conducted by your lender, checking the box to say you spent the funds appropriately, you didn't, you know, if there's no fraud or misrepresentation or gross misconduct of how you spent the money. And they have to go through that exercise and then give their recommendation to the SBA who remits payment back to the bank. Eligibility, however, has a 6-year statute of limitations. And so the SBA, as they've already said, want to review any loan amount above $2 million in conjunction with forgiveness. But they've not given any guidance as to practically how that review process will work. All we know is that the statute of limitations on eligibility and the SBA's review process is 6 years from the date you got the loan. So you may get forgiveness in 3 months. You may sell your, you know, everything might be fine, but in, you know, 3 years, the SBA may come back and say, well, wait a second, we actually don't think you were eligible to begin with. You didn't need the loan. So you didn't meet that certification. Now you have to repay it. And so I think what we're going to see for the next few years is we're going to see this in every single M&A process, regardless of whether forgiveness was given or not. And then on top of that, of course, and I think USI can probably comment more on this, but of course, the insurance companies are starting to create a product around this to protect against the lack of clarity from our wonderful government in the CARES Act. So, you know, there is an insurance product. I've heard that there's one carrier underwriting insurance to protect against forgiveness and eligibility, particularly eligibility. Forgiveness is separate, but particularly eligibility. You know, it's really pricey. It kind of looks like what rep and warranty insurance looked like way at the beginning in its nascency stages. And so we'll see. Unfortunately, the government has not given, I mean, unless someone on this call has a positive experience, I have not heard of one company, the SBA, issuing forgiveness. So we have no precedence for it yet. So time will tell. But that was an interesting development on the insurance front.
Yeah, and probably good to keep in mind that the government has a lot of debt and is going to be looking for ways to pay down and service its debt as far as we talk about capital balance sheets and so forth. There are a lot of things to be, I think, very cautious up ahead, irrespective of which political party moves forward. There are some major bills to pay without clarity on how they're going to be paid, which exasperates the prior things that we had of underfunded pensions and so forth. So I think insurance and things like that are depending on how the pricing is something really valuable to look at, or just understand it as a realistic, you know, risk of your deal. and understand that you might have to pay some or all of it back. And usually there's not a lot of empathy for the financial world. So that's probably good to keep in mind.
I want to spend a couple of minutes talking about the liquidity needs and alternative solutions available to portfolio companies, and really the support that independent sponsors can provide to portfolio companies in situation we're in right now. Sam, question for portfolio companies that are expecting short-term cash needs, how can investors help?
Yeah, and I touched on this a little bit before. Good question. You know, in some of our deals, if it's coming from, you know, in these cases, it's going to be some form of sub-debt or equity, most likely. In independent sponsor deals in particular, it can be an issue where you can, even at the outset of the deal in your LLC agreement, you know, agree on, you know, form and pricing or economics of, you know, a certain amount of follow-on investment that comes in for any situation. And so in some of these situations, that, you know, provision is being put to work. And that's a bit of an anti-dilution type benefit to a sponsor, that, you know, initially it's going to go into something that's not or less dilutive, or at least you understand what the pricing will look like. In situations where it's not, you know, pre-wired, or it's going to require more than that amount, you know, it's what I mentioned before. We're doing a lot of it's having to go in the form of equity because of, you know, issues and covenants. Most of our deals have third-party debts. You're having to manage to that. And then just, you know, what is the company's ability to take any, you know, incremental financial risk whatsoever, and what makes the most sense in solving problems. A lot of times that is equity, just given it's got the most flexibility and the longest time horizon. So we're putting a lot of equity capital into deals. As I mentioned, a lot of it is preferred, fixed coupon, trying to be non-dilutive. So once we get through this, or sorry, less dilutive, once we get through this, the appreciation rights are preserved to the extent they could be. And, you know, everybody's feeling, you know, relatively good that, you know, the base and the upside cases are still there, even if we're taking a lap for a few months or a year.
Yeah, and then from the kind of the independent sponsor, if we're dealing with the disrupt operations, what we can expect from independent sponsors? Is there some support? I think you talked a little bit about transparency, Sam, before, maybe control even?
Sure. So on the independent sponsor side, if it's not capital, and in a lot of our deals, the sponsor has you know, put in cash equity as well, or roll the fee, and so they'll have preemptive rights and can, you know, provide support that way. And if that's not available because it's an independent sponsor or balance sheet limitations, whatever, then I don't think there's anything incremental expected, because in our deals we don't have overlapping responsibilities. We're not an operations-oriented group. That's what the independent sponsor is there for. We can add value, you know, around the edges, but we're a support role, and hopefully it's just, you know, reconfirming, you know, either the strategy, you know, the day-to-day oversight that sponsor provides, and probably more of it, just given the higher velocity of just big decisions needing to be made. But, you know, I don't think there's anything incremental expected. It's just the same when, you know, ownership needs to be involved. The tip of the spear is independent sponsor, and you're getting a lot of opportunities to flex your muscle for what the value you said you were going to add, and the partnership that, you know, we're both in, hoping to, you know, work together as a team and do what we both can do to help get there.
You know, Natalie, when you have a problem, you go from having a call every 2 weeks to a call every week, and then to a call twice a week, 3 times a week. Finally, you're at it every day, and you're figuring out what the heck you're doing. And
to Tom's point, that positively correlates with the amount of third-party capital you have in the deal. So like Brett was mentioning before, and we pursue this as well, if you're in deals where there's a lot of homogeneity in the capital structure, or said differently, all or most of the capital is just the independent sponsors and, you know, us or a Star Mountain, those calls are less than they would be otherwise. In most cases, significantly so. Because senior lenders, they don't sign up for, you know, 10 and 15% or more return risk, and we're in that situation right now. A lot of lenders have 5, 6, 7% all-in returns they're expecting on these deals that are jeopardized, so they don't have a lot of margin for error.
You're on mute, Natalie.
Ooh, okay, thank you.
You just seen if you were paying
It had
attention.
to happen at least once during this panel, right? Somebody had to be reminded to unmute. Thank you. And I just want to, before we wrap up this discussion, I just want to ask really all of you, what are you anticipating, or are you anticipating the increase in M&A activity, and as investors and companies try to turn this crunch into opportunity and really accelerate the deal flow before year end? And Heather, perhaps we can start with you.
Yeah, we talk to bankers and other deal sources all the time, and the general sentiment, and I think we're starting to see it come through in the numbers, is that we're going to see or are seeing an uptick in M&A activity through year end, not just for add-ons, but for good-sized platforms as well. We have a company under LOI that for as a platform that we're hoping to close before year end. And so no one's afraid of it. I think lots of entrepreneurs, bankers will tell you that they're getting inbound calls from folks that they've been calling on for years and years saying, when are you going to sell? When are you going to sell? And they're calling and saying, I'm so over this. I can't go through this again. I'm out. Now that's if they can get the valuation that they're looking for, or maybe their target has come down because they've done so well the last 10 years and are just ready to sell. And then having the non-control sort of minority recap option through our Flex Fund, we expect to see a substantial uptick, and already have, in that type of activity as well. People who aren't ready to sell because the valuations aren't quite there, but need some growth capital, a partner to accelerate that over the next couple of years before they sell. So all in all, I would say we are fairly optimistic. I think I won't even go to the elections, but I do think that is its own hurdle as well in terms of next year's activity. And that's a big question about how our economy will respond to what happened this year, and what the medium impact of that will be on our companies, regardless of whether they survived this year or not. So lots of questions to be answered.
Brett, can we hear your thoughts?
Yeah, so hopefully lots of activity. I think the things that are trending in our favor to have a little more intellectual response is a retiring demographic. So if you're focused on owner-operated type businesses, at some juncture, people generally need to do something. People aren't retiring at 55 like old models used to say 15, 20 years ago. But that baby boomer population, a lot of them are in their 60s, late 60s, getting to early 70s. So I think that's a positive, for all of us in the deal making and investing community. The other positive right now is the supply demand dynamics between the lower middle market and what I'll just generically call the middle market, right? If you've got a business that's and again, I'm picking very broad numbers, it's not scientific, and as we all know, the world's merged, but if you've got a $20 million EBITDA business performing reasonably well, diverse customer base, Covet, and so forth, you can access quite cheap debt and get quite high valuations. So the demand drivers for smaller businesses to try to grow strategically, including through add-on acquisition, and for two businesses to say, hey, let's find out a way to come together where 1 + 1 can equal 2.5. There are a lot of reasons to try to grow your business. So that's another, I think, very large positive that we didn't see in the last two recessions, where the middle market remained quite fluid with valuations high. That is the case post this, sort of shorter recession that we've had. So those are the good, I think, things happening for us. Obviously, the challenges, I think Heather's already done a really good job pointing a number of them out, so I won't elaborate on that. But I think that we'll see a good next few years. There was another question asked on the Q&A by Rob around how do you really think about the working dynamics in this post-COVID world and how long things are going to last for and so forth. And I think what that calls out is we all have to be more operationally minded in our due diligence and our operations and how we're vetting partners. because the world is evolving quite quickly and in ways that are hard to forecast. So you just have to have more agility. And a big part of the agility is the operations, as people have talked about the cadence of talking to people, right? That's great to talk, but we also need to make sure that you have the right team in place with the agility to move and make things happen. So I think the focus on operational capabilities, KPIs, reporting capabilities, I think those are going to be growing, which creates another burden on smaller businesses where I don't think people are going to accept, oh, sorry, I'm small, I just don't have good reporting. I think those type of businesses just won't get the interest from the capital community. And I think a lot of business owners will start to utilize, embrace, invest in technology more and more dashboards and more reporting allows people to work remotely much easier, allows investors to get comfort much easier, so on and so forth.
And Tom, what is your outlook on the transaction for the remainder of 2020?
You know, it's September 14th. If you don't have the deal under LOI, you're not closing it this year. But keep working, because there's, you know, January and February will be great too.
Sam, do you want to be the last one to kind of say a few words on your outlook for the I guess the remainder of this year and the next year, the following year?
Well, for going into next year, I echo Tom's sentiment. You know, if you don't have it under LOI, it's not happening this year. You know, next year, I have no idea. I honestly have no idea. I think we all just have to keep making the best of what we got. We're all using, you know, these virtual solutions to meet and trying to pick our spots of getting on a plane or getting to a company. And I think until you're out of that situation, we'll still be at a fraction of what we were before in terms of activity. That's probably the best I got.
Right. And we do appreciate all our panelists today. This was a great discussion. Thank you so much. I do believe we answered all the questions that came in through this last hour. However, if you do, any of the listeners have any additional questions or help or a need for any advice, or please feel free to reach out to any of us. And most importantly, we wish all of you stay healthy and well and optimistic. Thank you so much again.
Thank you, Natalie, and thank you to our panelists as well. We appreciate that. I think it was a great discussion and a lot of engagement from the audience. So I definitely want to echo what Natalie said. If you have any follow-up questions, feel free to reach out to our panelists. I'd like to thank our sponsors as well for their support today, and to all of our attendees. We do have a ton of webinars coming up, even just 3 coming up in September in correlation with our upcoming Deal Connects as well. So look out for more information on those. If you are participating in today's Deal Connect event, you'll be logging out of Here Now and logging into a separate link that my colleague Terrence has already circulated. So you'll want to do that now. If you have any questions, in the meantime, feel free to reach out to the Opus Connect team. But again, everyone stay healthy, and we look forward to seeing you all soon. Thank you.
Have a good one.
Take care, everybody.